and welcome to Biztech's Inside Trading Show. This is a show all about trading. Every week, we discuss what trading is all about and the required habits to make you a successful trader. And we also share trading ideas and themes to really help you make money. And as always, my co host today is Leung. He's the founder and CIO of Track Record Academy. Now, V, welcome to the show.
Hey, it's good to be back, Brian. Let's talk about trading.
Let's talk about trading. Lots have happened this week with the Fed. For a start, let's take a look at a quote from Ray Dalio.
Yeah, let's do that. As always, we start off with a trading tip or trading quote. And what Ray Dalio says, he is one of the most successful hedge fund manager of our time, says what is most important isn't knowing the future, but it is knowing how to react appropriately to the information available at each point in time. And I think this is especially relevant given the state of the global macro situation right now, where most people are confused about what's going to happen from here, given so many unknown factors, as well as with regards to the U.S. Federal Reserve's policy going forward as well.
So this is interesting, V, because the reality is the following. What this, in a nutshell, means is be prepared with a couple of scenarios and act according to the scenarios. You don't have to have a crystal ball. You just need to be prepared.
Yes, that's exactly right. I think I think one of the biggest mistakes that investors and traders can make is to have a preset path of what the future is going to be like, right? And they get very irritated when the outcomes in reality do not conform to their mental picture of what the world should be, right? And this is the one of the biggest mistakes that traders make, is that they become very strongly opinionated and strongly believe in one particular outcome in the future, and become too much invested in that outcome, right? And they do
Okay,
not change enough as changing information comes to the fore.
so V, we have a confused environment right now. We've just had a Fed rate pause. Give us some insights into how we can apply these trading tips into what's happening right now in markets.
Okay, cool. So let's just summarize what exactly did the Fed do this week, right? What they did was they left interest rates unchanged. It's the first time in uh, after 10 consecutive hikes since March last year, where cumulative hikes of 5% in total, right? So what we have now is the first pause, and uh, they surprised though with the pause was pretty much expected, but they surprised with projection. Median projection means 9 committee members projected 2 more rate hikes this year. That is a surprise to the market. Most commentators and analysts, they were expecting just 1 more at most, right? But that was a surprise to the upside in interest rate projections. They brought it, they gave this projection in their quarterly on a quarterly basis. The last one that we received from them was in March, and at the March they were projecting peak interest rates at 5.1%, which is currently where we are right now. And they have since then they believe they have had information to revise this upwards. So they believe there's 2 more interest rate hikes of 25 basis points each, and bringing us to peak interest rates, which is what is the highest policy interest rates they believe they will get to before they will have to start cutting interest rates, or keeping interest rates there, and then start cutting interest rates, right? So that's a surprise to the upside on hawkishness. And the pause, however, was made, they say their reason given was to assess additional information and its implications for monetary policy. So I guess they're talking about lagged impacts, right? It takes some time for interest rate hikes to affect the economy, to affect the consumer behavior, and affect inflation. And of course, most of the aggressive rate hikes that came was towards the end of last year, in summer of last year. So they are expecting to see more of that impact later on this year as well. So we are now in June. Likely we'll start to see more of that in the form of credit tightening, as well as lower inflation and slower job markets. So overall, the Fed policy decision expected, but the dot plots, the projections, they were not expected, and they revised it stronger. So it was a hawkish policy decision, and we saw stock markets corrected from the highs, dropped almost 1%. Nasdaq dropped almost 1% in instant reaction. That was the policy statement part as well as the economic projections. We also saw them revising GDP, unemployment, and inflation, which core PCE deflator is their preferred measure of inflation, is much more important to them than the consumer price index, because they believe it measures a broader base basket of goods that's more relevant to the American consumer. So they revised economic growth higher for 2023, unemployment lower, so it means a stronger jobs market, and inflation also higher. As a result of that, they believe that the median number of participants believe that there's going to be 2 more interest rate hikes this year before they end the cycle of hiking. But for 2024, they believe their projections is around the same, slightly slower economic growth, slightly stronger jobs market, and inflation projections pretty much the same. So they believe that although this year the economy is going to be stronger, inflation is going to be higher, but they're going to react with 2 more interest rate hikes if necessary.
So here's what's interesting about just this little bit of data. The 2024 number for unemployment doesn't get much worse. So, in other words, what you could infer from that is yes, we are having credit tightening, we're having a downturn that's coming. But if the unemployment number is only zero point 0.4 up from their previous forecast, that doesn't seem that they are forecasting a very severe recession.
Yes, I think they still believe there's a pathway to a soft landing, right? They believe that it's possible, but of course the market doesn't really agree with that as yet, right? Because we are hearing lots of news articles talking about possible recession in the near future, right? But the Fed chair, Powell, did repeatedly say projections are pretty much not really reliable, given that it is quite far in the future. A lot of things can happen, but this is their projections for now. Yeah. Moving on, they did so the dot plots, as we said, right? They did revise their projections of interest rates higher based on, so the number of dots represent the number of the members of the committee believing that their projections is that they just collate. So it's not a consensus thing, it's just an individual collation of the individual forecasts, right? So but interestingly, the Fed chair did, in his press conference, did stress that these are just projections and they are not necessarily going to happen. It's just that each member of the committee believes this to be so. So the way that he spoke gave the market in general feeling, right? It's almost like he is the less hawkish one of these less hawkish dots, right? Yeah, he doesn't seem convinced that it's going to be 2 more interest rate hikes before the end of the year. So what did he really say in his press conference that I found really interesting was that he accidentally said that he skipped this meeting in hiking interest rate. He skipped this meeting and he immediately walked back on it, saying that it's not a skip, it's a pause, because they have not yet decided on what to do in the July meeting. So it's not a foregone conclusion that they're going to raise interest rates in July. So he made it a point to stress that they did not even discuss what they're going to do in July, right? So it's not a foregone conclusion that it's not as if they discuss, are we going to hike this meeting, or should we just skip this one and hike in July?
This is consistently what has been the case with the Fed, with Powell in charge. He's always said it'll be all the decisions will be data driven.
Yes, exactly. It's true of the last few meetings, right? And earlier on in the hiking cycle, they always said that more policy action is required. More policy action is required. They foresee even more hikes, right? So in the last few ones, they started to say it's yet to be determined how much more is required. Of course, this is the first time they've paused in more than a year, and this is the first time where he specifically wanted to say this is not they did not make this decision in consideration of 2 meetings at the same time, right? So he stressed repeatedly throughout the press conference that July meeting is a live meeting, meaning that they have not yet decided what to do. They could hike, they could pause, continue to pause, and they have not yet made any decision. And as you say, they're highly data dependent. So he did also say that the factors for disinflation are starting to come into play. which is obviously the game plan from the beginning, right? When you high interest rates, you expect to create these inflationary effects in the markets. Although confidence-wise, like for headlines, it's a shocker, right? That you see, the Fed hike interest rates by a quarter of a percent, three quarters of a percent, continues to be hawkish. But it takes time for that to filter through to the economy, to impact the credit conditions, to impact consumer confidence. Since I believe some of these are starting to happen and starting to come into play. If For those who have been following inflation, CPI, consumer price index, and producer price index data, it has in this week alone, it has undershot expectations. So I believe if this starts to continue, as it should, when inflation is on the way up, it tends to overshoot expectations. As on the way down, it tends to also overshoot expectations on the downside, right? So I think we're going to see more disinflation, and we're going to see more of this translating into dovish action. So what happened in the market reaction was, in the first instance, when the statement was released, the economic projections and the dot plots were released, stock markets fell 1%, fell nearly 1%. 1% was Nasdaq, 0.8% was S&P 500. But in the immediate aftermath, as the press conference started, risk sentiment improved, investors and confidence improved as well. Nasdaq bounced around 1.5% from the lows and ended the day up 0.7%. So I think that's exactly the interpretation of most investors, right? That the statement was hawkish because and the dot plots were hawkish because two interest rate hikes was projected for the year, but the press conference was the Chairman Powell saying that there's no foregone conclusion. The projections are just projections. It's not necessarily a promise to do anything, and we are highly data dependent from here.
Now, V, thank you very much for your insights. How do we play the game from here?
How do we play? Yes, exactly, right. So I think the mistake that a novice trader or an investor would do is to decide right now: is this the end? Is it the Fed is done with it or not done with it? Right? Some people will want to decide right now based on their feel of what they think inflation is. I can assure you this: I've been in the markets for years, and I've been in hedge funds. I've spoken to as very sophisticated hedge funds, and if you watch the show Billions, you'll see that they do a lot of analytics, right? And it's pretty much close to the truth. And they also don't get the inflation projections right, and that's what the Fed chair was telling us as well. Projections out beyond 1 year is pretty much just random guesses at some level, right? So we don't know yet exactly what the Fed will do, but we need to, as you said earlier on in the show as well, we need to figure out what they will do in each scenario, right? In each scenario, and how the market should react and how we should profit from that reaction. So I think we are very close to the end of the hiking cycle. It's possible also that May, which is the hike of a quarter percent last month, could be the last one, right? Could be the last one. The market now prices for one more, less than one interest. The probability of one more interest rate hike before the end of the year is roughly around 80% by the September meeting. For the June meeting, is slightly above 60%. So it's not a foregone conclusion. The markets do not really believe that the Fed's projection of two interest rate is a true promise. So, but what if it is the last hike? U.S. stocks have generally rallied after tightening cycles, and I guess that the difficulty is to figure out when is the last hike, right? You won't know until after a few pauses, then you realize, yes, that was the last hike. But what happens if it's the last hike? After the last hike, 3 months after peak interest rates, peak Fed funds interest rates, which is the policy interest rates, the S&P 500, which is the major stock index in the US, returned an average of 9% out of 6 instances. Only one is a negative outcome. So you lost 1% if if it turns out to be the worst case scenario in the last 6 instances. For the other 5 instances, it was all positive outcomes with a max of 14% in 3 months, which is not bad. Average is 9%, right? So that's quite a good result. And over the 12-month basis, it was an average of 19% positive outcome in last 6 instances as well. It's minus 11%, which is quite painful for the one time that after the Fed hike the last time, 12 months later, stocks were still down 11%, went down further 11% after the last hike. But the best outcome was a positive almost 40%, but average outcome 19%. That's a great outcome for historical studies as far as we can see, right? So what's important, bringing back what Ray Dalio said at the beginning, we quoted him. It is not important to try to predict the future. I have no clue. You have no clue. I don't believe the Fed also has a clue as to
Yeah.
when they are going to do the last hike. But we should be prepared that if the last hike has been seen, or if the next hike is the last hike, I think over the next 3 months after that and the 12 months period after that, it is a good risk reward proposition to be invested in the US stock markets.
Now, on that note, V, thank you very much for your insights. We are wrapping up today's Biztech Inside Trading Show. We've been speaking to Leung, founder and CIO of Track Record Trading Academy. I'm Brian Fernandez, and this has been Biztech's Inside Trading Show. This show will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.